Welcome to the management conference for Chicago booth. This year we're virtual, and hopefully by next year, maybe we'll be back to being in person. My name's Anil Kashyap. I'm a faculty member at Booth, and I've got the privilege of moderating a panel that I think is incredibly timely and topical. One of my favorite papers in economics starts out by saying, "There are idiots, look around." And that's something that economists have always been aware of. But it seems like in the last few years, the public has decided that we're the idiots, and that we're not to be trusted, and that people are free to have almost data-free opinions that are perhaps widely debunked, but still tightly held. And so the idea from this session is going to be to discuss how you get ideas across in a world where expertise is got low credibility. And we're joined by three fantastic journalists, three of the best in the profession of economics journalism, that are each going to start out by giving some introductory remarks where they share how they have communicated complicated issues to the public in this environment. So I'll briefly introduce them and then we'll get right to the substance. Our first speaker will be Chris Giles. He's the economics editor for the Financial Times, where he's been in that position since 2004. His reporting covers global and UK economic affairs, and every couple of weeks he writes a column, and he will be talking to us about Brexit. Our second speaker is Catherine Rampell. She's a syndicated opinion columnist for the Washington Post. She often covers economics, public policy, immigration, and politics with a special emphasis on data-driven journalism. And she's also a commentator for CNN, a special correspondent for the PBS NewsHour, and a contributor to Marketplace. And then our third speaker will be Jeanna Smialek. She's the Federal Reserve and economy reporter for the New York Times. She reports on the Fed regularly and is actually writing a book on how the Fed has evolved for the 21st century that will be out soon. So each of them, and Catherine's going to talk about taxes, Gina's going to talk about the Fed monetary policy. So over to you, Chris.
Thank you very much, Anil. I'm going to talk about, as you said, the sorry tale that was Brexit, and how experts certainly were not trusted by the UK public, and it was very, very difficult to get a sensible debate going on the economics of Brexit in the referendum of 2016. Let me just recap very quickly what happened. So the government, after it was elected in 2015, had a promise in the election to hold a referendum on whether the UK should stay a member of the European Union, where it'd been a member since 1973. We had an extremely heated and ugly referendum campaign in 2016, and the UK voted to leave in June 2016 by a margin of 52 to 48. So it was very close. It was always going to be close. Could have gone either way, but it certainly went against the side that was called Remain. So the two sides were, one was remain in the EU or leave. And ultimately, the Remain side tried to use economics as its main argument, i.e. you're better off if you remain in the EU, whereas the Leave side attended, or they did use economics a bit, quite bad economics generally. They tended to use identity and agency as their main arguments. And it was very clear to me by the end of it, and to most economists who are pretty appalled by some of the tone of the economic debate, that identity definitely trumped economics in this debate. So let me just really very quickly go through the very basic economics of Brexit as the profession, and when I say the profession, when they were polled, about 90% of the economics profession in academia and in market sector would agree with this standard view. You can look at the past about what did the EU do to the UK's economy, and there you would try and look at how the issues about, in terms of customs unions, about trade creation, created by having no barriers between the UK and the EU versus trade diversion, that you might get unwelcome diversion of trade from the rest of the world to the EU. And all the studies essentially show that creation, one, this was good for the UK, both in a static sense that there was more trade creation than diversion, it helped GDP, but also in a dynamic sense that the integration of the European markets tended to raise competition, generate economies of scale. And ultimately, there's lots of other things going on, but the studies tended to suggest that the UK was about 10% better off having joined the EU than had it not joined. And this, I mean, goes in a lot of ways back to sort of, if you look at the history, the UK had a very bad post-war economic history up to the 1980s, and then had a recovery where it outperformed most of the other European countries. Now, some of this is obviously bound up in many other reforms that are happening to the UK economy. It's very difficult to distinguish EU membership from other things, but this is roughly where the numbers tend to come out. So that was one way that experts looked at the issue. Another way was to look at the future, where it's really about trade economics, about whether you are going to be raising trade barriers with your closest and largest trading partner or not. And this is all about friction at the borders. We expected to get some sort of free trade deal, which we have ended up having with the EU, but it's about really close trade, of frictionless trade between the UK and the EU. And there's lots of ways you can try and analyze this. And there were countless studies, domestic, international, all sort of suggested that the hit to the UK economy in the longer term of leaving would be somewhere between 2% of national income and 10% of national income. It really depended on how you did it, but there was definitely going to be a hit. And this would more than offset effectively the membership fee of joining the EU for the UK, which there's essentially a bill which is shared expenditure, where the UK pays in more than it gets out. So that was the standard economics. The economic argument lost in this debate, quite clearly lost, and unequivocally, I'd say, lost. So when the public were polled about whether they believed the sort of evidence, 70% thought the estimates of losses that economists came up with were false. Only 17% thought they were true. The majority thought the leave side, which said that the UK was paying £350 million a week to the EU, which was determinedly an utterly false number, that was big and that was true. And the majority thought that a long-term effect on the UK economy would likely be positive, even if there might be a short-term hit. There was a lot of polling done on what the public believed. So I think one of the big questions is, why did economics lose this argument? Why did standard economics lose? I think one thing which was difficult about getting across was time horizons. There was a bill paid every year from the UK to the EU, which wasn't £350 million a week, it was much smaller than that. But the moment people started arguing about what the level was, then that highlighted to the public that there was a bill, whereas the long-term effects of lost income and better economic performance was essentially rather amorphous and not a concrete example, that people tended to think that it was just sort of made up. The second thing that was very difficult to get across was the issue of counterfactuals. If there was likely to be a 10% hit to the economy, the question always asked was, how do economists know this? How on earth can they come up with these things? Aren't economic forecasts always wrong? Isn't this obviously stupid? And now we've tried lots of ways to try and get across that there are unconditional forecasts and there are conditional forecasts. So if a doctor cannot tell you the day you're going to die, a doctor can tell you you're more likely to die earlier if you eat a pound of butter every day. We tried all these sorts of things, still totally impossible to get these sorts of counterfactuals and what is an unconditional and a conditional forecast across. Effectively, the other side, well, I would say the other side, I mean, I was certainly with economists, but the public tended to believe, people said, well, look, the forecast still says the economy is going to grow afterwards, even if it's going to be smaller than it was before. So they're lying when they say there's going to be a hit to the economy. And to try and get across the sense of income foregone was very, very difficult. There was a general distrust of expertise. The Leave side was quite willing to go on TV and say, we've had enough of experts in this country. It's now the time to, for gut feeling, and we can do this, to come across. And then the media, I don't think, covered itself in glory. We had two problems in the UK. In the newspaper media, which is hyper-partisan in the UK, the majority of newspapers were highly on the Leave side, and would just put essentially propaganda in their news pages, which is I think unusual in the US to know exactly how hyper-partisan a lot of even our quality press can be in the UK. And then our broadcast media, which has to follow impartiality rules in the UK, had a different problem, which was that they felt they had to give both sides absolutely equal airplay and equal time on the economic debate. And so the small number of economists who supported Leave on economic grounds realized this and were really very, very effective at always being up and available for interviews. So they would always get on TV and they would have exactly the same amount of airtime as the very large number of economists who thought it wasn't a great idea. And that gave a sense that these things there was a balance of argument. It was equal on either side. And it has to be said that the Remain side also exaggerated the economics. So the economics suggested there would be a long-term hit, it would be gradual over a long period, whereas the politicians did definitively try and say it would be Armageddon and the country would go into recession immediately. There was a vote against. So I think those are the essential reasons that the Remain side lost, found the message very difficult to get across. And in the years after the referendum, the UK economy has duly underperformed. When you look at this carefully against previous forecasts or against other countries, it's lost about 2 to 3% of GDP relative to what a reasonable expectation could have been had the vote gone the other way. Very much in line with what expert predictions said. And this is also, and again, this hasn't necessarily been believed. It's been very hard to get across even that counterfactual. So I think my conclusion is that economics really tried pretty hard, but failed. It failed to give a positive vision, giving quite a negative vision. It probably should have been noisier. Economists should, particularly academic economists, should have been noisier. And it did have to expect to get quite down and dirty in what was a very, very virulent public debate. But I think what the conclusion I came away with was it's very hard to beat determined populists with rational arguments when they have no worries about lying whatsoever. I'll stop there.
That's a cheery note to end on. There was a famous exchange during the financial crisis between Ben Bernanke and Barney Frank, where Bernanke was trying to explain about counterfactuals. And Frank, after listening to him, said, that's all well and good, but the idea that we're going to put on our bumper slogan, our slogan on our bumper of our cars is, it could have been worse, doesn't really work very well. Let's now turn to another cheery subject, taxes, and Catherine.
So thanks for having me. As our audience heard, I'm an opinion columnist, not an op-ed columnist, and I write about a lot of different subjects, but including things unrelated to economics. But one of my favorite topics to write about is taxation, which always has some nexus with the news. And I like writing about it in part, I think, because it's in my blood. I'm descended from multiple generations of accountants, but it's also just very interesting, it has lots of economic, behavioral, political questions inherent in it. On the other hand, it can be very challenging to write about. My job as a journalist is to try to explain issues of taxation to the public clearly, about how the tax code works and how proposed changes in it might affect their lives. That's a little bit different from what the objectives of experts might be, right? experts who work in public finance tend to be talking about things with a much higher degree of specificity and technicality for an expert audience. And a lot of this is inherently complicated or not terribly intuitive. The tax code is opaque, sometimes by accident, and I think sometimes by design. And the other thing that makes my job in writing about taxes a bit harder is that readers, of course, have personal experience with paying taxes, so they think that they are experts in the issue, even if there are a lot of moving parts that may not be totally visible or salient to them. And then there are plenty of political activists, of course, who have a vested interest in telling a particular narrative about how the tax system works or the consequences of particular changes to it. And sometimes those are people masquerading as experts who don't necessarily have a grounding in the actual technical details, and that can all muddy the conversation as well. So basically, anytime I write about anything related to taxes, I am flooded with angry and sometimes confused reader emails. And I thought what I would do today is talk a little bit about what the common tripwires are. The longer I have been in this business as a journalist, the more I feel that I kind of have to write defensively in a sense, by which I mean proactively anticipating the likely points of confusion that an issue is likely to raise or spin, for that matter, and anticipate them and figure out how to write clearly so the reader understands what's going on. So sometimes the issue is something pretty basic, like there's a lot of confusion I have found about the relationship between your tax refund, which is how much you get back from the IRS, if in fact you get anything back at the end of the year, and what your actual tax liability is. And those are two very different things. Your tax refund can go up or down. Your tax refund might go up a year, even if your overall taxes remitted went down. And that can happen because your withholding changes or what have you. So that's like a pretty basic example of what I'm talking about. But another common thing might be confusion about average tax rates versus marginal tax rates. Every time there is a proposal to increase taxes, for example, which happens every few years at the very least, there's usually like some local news story that goes out and interviews a bunch of restaurant owners or other people who say, I'm going to do my best not to pass that $200,000 threshold, where the taxes are going up, because they hear taxes are going up on people making over $200,000 or whatever, and they think that it means that applies to every dollar rather than the marginal dollar. So sometimes it's just explaining to people how tax brackets work, and that there's a difference between a marginal tax rate and an average tax rate, and that raising taxes on the margin does not necessarily mean, unless it's a really badly designed tax, that all of your income is now going to face a higher tax rate. And this is not just like random readers, by the way, who get confused about this. I remember in 2012, I guess it was, whenever Herman Cain was running for president, the late Herman Cain, talking with his economic advisor about the 999 plan. And it was pretty clear that neither the economic advisor nor Herman Cain understood the difference between marginal tax rates and average ones. Another common source of confusion that I have to think about when I'm writing is the difference between the statutory versus economic incidence of a tax, by which I mean the difference between who remits the tax to the government and who ultimately bears the burden of it as prices adjust. This came up a lot during the Trump trade wars, as some of you may recall. President Trump and his advisor Peter Navarro and others argued that by imposing import taxes on Chinese goods, that meant that China was going to be paying us tariffs. And Trump even specifically said that he was going to compensate US farmers who had lost out on business because of retaliatory tariffs by extracting that money from China, which is not how any of this worked, of course. I mean, I have this tweet that I pulled up where he said in January 2020, the farmers are really happy with the new China trade deal and the soon-to-be signed deal with Mexico and Canada. But I hope the thing that they will most remember is the fact that I was able to take massive incoming tariff money and use it to help them get through the tough times. In fact, he was making transfers to farmers, but those transfer payments were basically being paid from one contingent of Americans to another contingent of Americans, not by the Chinese. And we know that in part because there were a bunch of studies that came out, empirical studies, including one I think that was co-authored by a couple of economists at the University of Chicago, looking at who was bearing the cost of these Trump tariffs, not just the China tariffs, but also the washing machine tariffs and others. And they indeed found that most, if not all, of the incidence was being borne by Americans. And this comes up in public discourse about other taxes too. Things like if there's a payroll tax holiday, who actually benefits from that? Or if there's a corporate tax increase, does that mean that workers, in fact, may also be hurt by that? Who bears the incidence of corporate taxation? And sometimes I wish there were more empirical and recent studies addressing some of these questions. But it's difficult to communicate all of this in any event to readers. Another thing that has been in the news recently that presents sort of a nexus or a confluence, I should say, of a number of sources of confusion is the SALT cap deduction, which some of you may be familiar with. So as part of the 2017 Trump tax cuts, the federal income tax code now limits the amount of state and local taxes that individuals can deduct on their federal income tax returns, which for high tax states and counties, including New York, where I live, probably if you live in Chicago, you're maybe dealing with some of this too. That sounds pretty painful, except that the same law also doubled the standard deduction. So a lot of people who might have seen their federal tax liability go up because of this SALT cap didn't, because the standard deduction became so much more generous that they didn't need to itemize. And of course, as a result, tax liabilities went down across the board, including for most people who live in those high tax states. But it's very difficult for people to keep track of all of the moving parts within the tax code, especially since, as I said, withholding and refunds can kind of obscure what's going on. And so a lot of people had no idea that their overall tax burden went down. And for example, even in high tax blue states like New York, New Jersey, California, almost every tax filer got some sort of tax cut. In New York, for example, only about 8% of filers actually saw their taxes go up on net as a result of the combination of all of the law's individual provisions. And right now there's a big debate from Democratic lawmakers within those blue states, particularly New York and New Jersey. They have threatened to basically hold Biden's infrastructure plan hostage unless they get this SALT cap repealed, claiming that they are just asking for a middle class tax cut, when if you look at who would actually be affected by this, it's a tiny share of people, and they're almost exclusively people making more than $500,000. The Tax Policy Center found that 70% of the benefit of repealing this cap would go to households making $500,000 or more. But if you tell this to the public, they don't believe it because they're paying attention to the one individual provision. They don't understand how the things interact and don't necessarily understand the overall progressivity or regressivity of the tax system. So it's complicated. Another thing that frequently comes up, both in the context of the SALT cap and other issues of taxation that are in the news, has to do with double taxation. That people will say, oh, it's a principle of taxation that no dollar gets taxed more than once. If the state is taxing it, then the feds shouldn't be. This objection comes out also with the estate tax or capital gains taxes, etc. Although if you talk to economists, they'll say, no, every dollar gets taxed multiple times, maybe infinitely many times. For example, I bought a bottle of wine yesterday with my post-income tax dollars. I paid sales taxes on those dollars at the register. The importer first, before that, paid tariffs, and the wine distributor paid an excise tax. The number of taxes is not really relevant. What matters is the rate applied to any one activity. But it's hard to explain. So if those out there have advice about how to explain this better to the public, I am all ears. Another complicated issue that frequently comes up when I'm writing about tax issues is one that Chris actually mentioned, which is talking about baselines, which are very tricky. Baselines, counterfactuals, it's a very tricky thing to talk about. Economists, I think, are well trained to think in those terms, but the public is generally not. And it's kind of makes sense, right? Like, how do you actually know what would have happened in this alternate universe? But it's the source of a lot of accounting gimmicks when various kinds of fiscal policy proposals are presented. And I think a lot of hoodwinking happens through, fiddling with baselines. For example, I remember arguing with some Trump surrogates in probably 2018, 2019 about whether the Trump tax cut had paid for itself, because overall federal tax revenue was basically flat between 2017 when the law passed and 2018. Of course, that was in nominal terms. Once you adjusted for inflation, revenue had fallen overall. And more importantly, what we care about is what revenue would have looked like in the absence of the tax cut. But that's hard to explain, first of all, and there's a lot of skepticism about, well, how do we really know that? How do economists actually know what the economy would have looked like, and therefore what tax revenues looked like? It's very challenging. And then I think the final thing that I would mention that is an ongoing and very live issue right now is how to think about pledges that politicians make about taxes. For example, Biden has promised not to raise any taxes on the middle class, which he has defined as anyone making under $400,000, which is about the 95th percentile, give or take. Now, the middle class, of course, definition has been expanded quite a bit since Obama left office. Back then, it was $250,000 was the upper bound. There's been some inflation since then, but not that much. But more to the point, this is a very narrow base from which to try to fund all of the very ambitious things that Biden wants to do, including on infrastructure and the care economy and various other initiatives. But I think there is a widespread perception that there's enough money from just the small sliver of the top 5% that can be shaken loose to pay for everything. The money tree from the millionaires and billionaires has enough cash on it to shake loose, when in fact that's probably not a fair assumption. And that if we want to be thinking about a safety net and welfare state that looks more like those in other countries, in other industrialized countries, we probably need to look at how they fund it, which is through much broader based taxation, like a value added tax, which is sort of anathema here. So getting people to think about, how much free money is there out there, and how distortive are some of these taxes is challenging. And there's so much distrust of any expert, in part because people don't trust experts in general, in part because a lot of people masquerade as experts when they're really more like activists, that it's very hard to have an honest conversation about a lot of these issues. And with that, I will wrap up. Plenty of other sources of confusion to talk about.
Okay, that was great. So Jeanna, you're up, and we'll get to hear about monetary policy.
Right. If anything's better at confusing people than taxes, the one and only thing may be monetary policy. Yeah, so as you mentioned earlier, my name is Jeanna Smialek. I cover the Fed and the economy at the Times, which I've done for a few years now. I've been covering the Fed for about 8 years. Previously covered it. Oh, sorry for that. Previously covered it at Bloomberg News. Zoom Live, right? But previously covered it at Bloomberg News, which was obviously for a slightly wonkier audience. Also covered it for Bloomberg Television occasionally, which is a little bit less wonky. And then kind of just made my way down the spectrum to the New York Times, which is obviously a much more general audience. I'm also, like Catherine, a contributor on Marketplace, so also sort of business oriented, but general. And so I've had the pleasure of trying to explain monetary policy to a wide variety of people. And in the process of doing that, have kind of figured out that there are basically 3 buckets of Fed misunderstanding. The first, I would say, is just that the Fed itself is complicated. It's a sort of governmental, partially non-governmental organization that controls the price of money. It's got a complicated structure and it just confuses people. Readers tend to sort of intuitively understand what inflation and unemployment are and what they mean to them. And the way the Fed thinks about those things, which are its sort of primary goals, is not always the same as the way normal human beings think about those things. And certainly the way those things interrelate for the Fed's framework is not always intuitive to readers. I think the second bucket is that the Fed does complicated things. So beyond being complicated in itself, the way it goes about setting interest rates and sort of trying to achieve its goals can be very confusing. That hasn't always been wholly unintentional. You know, obviously during the 70s and 80s, we targeted money supply instead of targeting interest rates, partially because it kind of obscured what was happening as the Volcker Fed pushed interest rates into the stratosphere. Under Greenspan, the Fed started, so in the 90s, the Fed started targeting interest rates again, but it didn't even release those decisions until 1994. And so there's been sort of this long history of obscurity around the Fed that was at times seen as sort of a good in and of itself, that shifted to transparency in the modern era. But even as the Fed has become more transparent, it's hit the zero lower bound on interest rates. It can't cut interest rates any further. And so it started using really complicated policies to try and goose the economy back into health, and those confuse people. And then the third bucket of Fed misunderstanding is just that there are people out there who just want to misunderstand the Fed. It's kind of fun to misunderstand the Fed. It seems to be, you know, like a honeypot for conspiracy theorists sometimes. And I think that's pretty well illustrated by the fact that, you know, two of the books about the Fed, one much more conspiratorial than the other, are, you know, The Creature from Jekyll Island and The Secrets of the Temple. You know, an institution that attracts headlines like that kind of tells you something. So I think the first two levels of understanding, sort of this idea that the Fed is a complicated entity and it does complicated things, are really sort of incumbent upon the press to clear up. I think we can help with that communication. I see the Fed itself as sort of like, almost like misunderstood like a teenager when it comes to communication. You know, part of the misunderstanding arises from the fact that it's just really hard to understand and it's kind of out there doing its thing. And part of the misunderstanding arises from the fact that it's not always the best at communicating its wants and needs with the public. And so I think that's where the media really comes in. So I'm going to just briefly touch on three different areas where I think this has really sort of come to the fore within the last couple of years. The first is the Fed's new framework. The second is quantitative easing, so massive bond buying. And the third is the 2020 corporate bond program that the Fed undertook. The framework, which you guys may be familiar with, is something that the Fed unveiled last year. So after, you know, a couple of years of review and talking with the public, in 2020, Chair Powell at the Jackson Hole Conference, you know, rolled out this new idea that the Fed is going to shoot for 2% inflation on average and is no longer going to treat sort of overshoots of full employment as something that they need to lean against. And so it sort of walked away from preemption, walked toward a much more gradual pace of interest rate hikes in the sort of long stages of a financial cycle or business cycle. And I think what was really interesting about the framework review is that all of us came out with completely different leads. Like myself and all of my competitors, not a single person had the same lead. So I'm just going to quickly read you guys the Wall Street Journal's lead versus my lead and then kind of talk through the differences. So the journal said, the Federal Reserve approved a major shift in how it sets interest rates by dropping its longstanding practice of preemptively lifting them to head off higher inflation, a move likely to leave US borrowing costs very low for a long time. So focused sort of on inflation, on borrowing costs. My lead was Jerome H. Powell, the chair of the Federal Reserve, announced a major shift in how the central bank guides the economy, signaling it will no longer raise interest rates to keep the unemployment rate from falling too far, and that it will allow inflation to run slightly higher in good times. So mine obviously very focused on employment. And so I think readers coming to these think that we're telling different stories sometimes, you know, that like I am sort of telling a different story or trying to obscure something relative to the journal or vice versa, when in fact we're trying to sort of interpret and make clear to very different audiences what the Fed is doing. And I think that sort of presents a real challenge. So I think the things that the press did well in covering the framework review is that we sort of honed in on what actually mattered to people, which is that this is going to leave interest rates a lot lower for a lot longer. And that matters to your mortgage. It would have mattered in the wake of the 2015 crisis. You know, I think people were quite familiar, or in the wake of the 2009 crisis and the 2015 rate hiking cycle, people were quite familiar with the 2015 to 2018 rate hiking cycle, partially just because Donald Trump had been tweeting about it constantly. And so a whole audience that's usually not that Fed familiar was pretty familiar with the idea that the Fed had raised raised interest rates to cool down the economy. And so I think we did frame it around that. I think the thing that was challenging was that some people were focusing so much on the employment change in the statement, and some people were focusing so much on the inflation change. And I think that that created some confusion for readers. So these things are hard to do. But I think the takeaway from that was just emphasize what it means to everyday life. The other thing that I think has been much more challenging to communicate than the framework review is quantitative easing. It is just extremely difficult to explain to the world why the Fed is buying $120 billion in bonds each month. It was a little bit easier at the start of this QE round because it was about market functioning and people just kind of got that. Now, a little bit difficult partially because the way economists talk about it ranges hugely. Depending on who you talk to about why the Fed is buying $120 billion in bonds, it's to keep interest rates low across the curve, it's to keep housing cheap, it's market functioning, it's just a portfolio rebalance channel, by which people basically mean it's chasing money out of bonds and into stocks and other risky assets. And so how do you talk about this when economists are talking about it so differently? For example, the Bank of England recently put out an explainer on QE and said that, and I quote, quantitative easing is a tool that central banks like us can use to inject money directly into the economy. Meanwhile, like Powell, for example, in 2013, talking about QE, described it as something that lowered long-term interest rates and raised equity prices and home prices, effects that support household and business spending. And so, just a huge range of how economists and policymakers talk about this. My personal preference in describing QE has always been not to use the inject money language, because I think it makes readers think that the Fed is just throwing $120 billion in green cash out the window every month. And that is not what they're doing. They're buying bonds, they're creating reserves and putting them on bank balance sheets. Those reserves may or may not make it into the real economy as lending. They do have some effect at injecting money into the system that is has some sort of velocity, but it's certainly not $120 billion of money. And so I think that it creates kind of this wrong, technically right, but meaningfully wrong image in readers' minds. And so I tend to give a description more like the one Powell gave. Now, in that case, I exercised a lot of discretion over how I'm describing these things. And I think economists could or could not disagree with me. But when it comes to the corporate bond buying program, it was much more challenging because it's much more divisive. And I think it's really hard as a media person to decide how to describe it. So what I mean by this is the Fed decided to buy corporate bonds for the first time in its history via its emergency lending programs in this crisis. So back in March 2020, as the bond markets are melting down, it starts buying corporate bonds. This was initially sort of hailed as just totally fine, but it quickly became controversial. Bloomberg came out with a story somewhere in April that was titled "The Non-Bailout: How the Fed Saved Boeing Without Paying a Dime." Totally fine. The Fed had restored market functioning by starting this bond purchase program. Thus, Boeing was able to issue bonds, didn't need a bailout. Unfortunately, the headline that ran online with that story was "Boeing's bailout saved by the Fed without paying a dime." This just absolutely ignited this firestorm online. Everybody wrote a story about the Boeing bailout. Matt Stoller, who is at the American Economic Liberties Project, put out a newsletter that was basically called "The Federal Reserve Bails Out Boeing," took off on Twitter. This huge narrative came out about how the Fed was bailing out the corporate bond sector and all these big companies. So what the Fed actually did was buy about $14 billion in bonds, which is less than half of what Boeing raised in that one set of issuance. So it was very much a backstop, not a bailout, but I don't know how you communicate that with the public. And so what we really focused on doing was just describing exactly what the Fed was doing, which was purchasing corporate bonds and ETFs in the open market, holding it on their balance sheet, but just doing a little bit to restore market functioning. We just kind of described exactly what they were doing and let readers make up their own minds. And so I think the takeaway conclusion from my remarks here is just that I think the key things for the Fed, communicating around the Fed, that we've come up with is basically summarize and simplify when you can, make it as salient as possible, tie things back to people's real lives. And then sometimes when things can't be simplified in a way that makes them, very easy to understand, or, the import very easy to understand, you just give people the tools they need to make up their own decision.
Thank you. That was great. And thanks to all three of you for sticking to the time, so we've got plenty of scope for a little bit of back and forth. I'll give any of you, I'm going to ask each of you one question just as a follow-up to what each of you spoke about. But if you want to comment on anything you heard from the others, feel free. So let me start with Chris. do you think we're almost going to get a do-over on the whole Brexit thing if there is another referendum in Scotland? When the Scottish referendum was waged a few years ago, there was a lot of misinformation. In that case, the Remain side hung on barely. Do you foresee that some of the stuff that was clearly misinformation the last time can be peddled again, or will there actually be some payback for some of the things that were incorrect then? And do you think a Brexit, a lot of the stuff that was wrong about Brexit is now widely recognized as such? So how do you think that will play out if there is a Scottish referendum?
Badly, I think, is the one word answer. As you rightly said, the Scottish referendum was just as bad as Brexit in terms of disinformation, particularly from the nationalist side. And even though all of their fiscal plans were blown out of the water within a month of the referendum, which they narrowly lost when the oil price fell, because they had essentially predicated the whole of their future fiscal policy on the oil price staying at $110 a barrel. Yeah. And there being a lot of oil in the North Sea, both of which are catastrophically wrong, means that now when the subject is again up for debate, they don't make those arguments anymore. But we're currently in the middle of the last week of a Scottish parliamentary election, which might or might not bring this subject back again. And the debate in Scotland, the economic debate in Scotland right at the moment, from all sides, so this is not in any way a partisan thing, is shockingly bad. So all sides of the Scottish debate, both the nationalists and the unionists, the people who want to stay part of the UK and people who want to break away, are basically pretending there is far more money available within the Scottish budget, and they can do far more than is plausibly possible in the next 5 years, given that the Scottish government only has a limited powers to raise its own taxation and limited devolved powers of expenditure, and already has 30% more spending per head than someone in England gets, because there's essentially been a deal where Scotland gets more money. And you can't seem to stop this debate being very bad. The Scottish media doesn't seem to have the same sort of ability to query all sides. And even though we've had some very good reports out of think tanks, really, high quality, independent, looking at just how bad the Scottish economic debate is at the moment, it's not seeming to stop it. So people, again, and my conclusion is that this makes it very hard when people want to believe things that aren't true and are absolutely desperate for other reasons. They will take an economic argument that might be specious in any objective sense and will run with it. And so if you are in a situation where people absolutely are convinced that there is a right and a wrong, they will try and use economics as a weapon rather than as a way of discovering what might be the best outcome. And that was certainly the case in Brexit. And so I think it's very hard to fight against that if that's going ahead. I totally agree with Catherine and Jeanna in what things you can do, but then you are relying on people actually wanting to learn and understand. And if you do, then I think there's a lot the media can do. The responsible media can absolutely do things, and so things that we do at the FT certainly, where it's not a really polarizing issue, is I certainly will try in reporting not to give a voice to people I know are going to be peddling things that are untrue. I don't feel I have any need to have a voice have their voice in there when what they're saying is untrue, or if I do feel I need to represent them because they are important in the debate, I will make it perfectly clear in writing where they come from, and so readers will know why, that they will know perhaps to maybe give their view less of a weight. I think graphics, explanation, myth busting, all of these things have their place. I think the accountant's adage that you want to be true and fair, and the and fair part of that being very important in these, is incredibly important in reporting, to make sure. And if you have to slightly be less true to give a fair view of the situation, I'm comfortable with that. If I have to choose between true and fair, I'll always go for fair rather than true.
That's bold. Catherine,
because strictly true can often be misleading.
Yeah, no, teachers take that shortcut all the time. You want them to understand it and get it right, and if you cut a corner, so be it sometimes. Catherine, we're going to have a big debate over taxes. I mean, Biden's got his plan out, and there's going to be back and forth on this. If you were trying to explain to the public some basic types of tax reform that would be, widely embraced by economists and maybe even feasible, do you have a set of things where, here's something that they could probably, both sides could agree on, that would move us forward and make the tax system kind of less complicated and less distortionary?
Well,
is there anything like that?
I think that there is widespread agreement that the tax code is too complicated and that it needs to be simplified in some respect. But what simplification means is often in the eye of the beholder. And a lot of the time, just speaking, so talking about like the political debate first, as opposed to what economists may recommend. A lot of the time, the political debate devolves into, well, we should just have fewer tax brackets, or a flat tax. When what makes the tax code complicated is not the fraction by which you multiply each bucket of income, which is what the tax bracket is. Reducing the number of tax brackets doesn't really do a lot to simplify the tax code. What's complicated about the tax code is what counts as income, what counts as a deduction or a credit, or what kinds of aggressive positions you can take about depreciation and things like that. So it's a lot. The overall theme, I think everybody agrees on, but what solutions are implied by that theme or by that identified problem are quite different. My impression is that economists are generally, well, it depends on your politics, obviously. Some of this is a normative question, but economists, generally don't seem to be fans of things that obfuscate who is actually bearing the burden of taxation, and that just reward tax filers who have armies of accountants and tax attorneys to try to mine the tax system for loopholes, intentional or otherwise. That's some sort of broader based taxation that doesn't end up requiring tax filers to expend a lot of energy figuring out how to minimize their taxes, that actually makes things simpler and that has the fewest distortions, of course, on economic activity. Or those are really the priorities. But again, it's all sort of putting that into practice is difficult. And, I think that there are certain certain changes to the tax code that there is widespread consensus on among economists, in particular a carbon tax, for the reason of not strictly for revenue raising purposes, but to deal with the externalities that come from carbon emissions. But just because economists agree on it, and there's this petition that has like thousands, I forget how many, but like thousands of economists who say this is the most critical tool we have, putting a price on carbon for dealing with climate change. In fact, 3 of the senior economists within the Biden administration have signed on to this petition, but it is like a total third rail politically. In part because taxes are bad in general, in part because, in the political discourse, and in part because Biden has made this pledge not to raise taxes on anyone making under $400,000, regardless of what you might do with that revenue. So that's a thing that economists agree on, but right now seems to have no political legs, unfortunately, I think. And then another category of taxation that I think, that I don't know if there's quite the same consensus on it, but that economists at least seem to be greater fans of is a value added tax, which basically every other nation on earth already has. It's very good at raising revenue. It is regressive. There's this famous line from Larry Summers that like once progressives figure out how good it is at raising revenue, and conservatives figure out how regressive it is, they'll like switch positions and they'll both support it, or something along those lines. And I think that will ultimately need to be in our future at some point. And its regressivity can be offset through other changes to the tax code. Like I said, you have to think about the overall progressivity of the tax code. But again, regardless of how much support there is among the technocrats, it seems unlikely to happen anytime soon.
Thanks, that's great. So Jeanna, there's so much that the Fed has changed in the last couple of years. One of the things that they've done is just talk much more about things outside of the narrow domain of monetary policy. I mean, there's this whole push for inclusiveness, and that monetary policy can be more inclusive. I think most economists would say that's not the standard view of how the monetary transmission mechanism works, where you determine the wage differential between Black and white workers and the unemployment rate between, you know, certain classes of people. How are you handling that? And do you think they're actually going to try to follow through on any of this, or is this kind of like a free lunch where they can say some stuff and figure nobody's really going to figure out if they're trying to do it?
So I think what they're saying precisely is often misunderstood. Like I think that they have clearly redefined their goal to be broad-based and inclusive, right? That they put that in the statement. But what does that actually mean? And they have not defined it. They haven't put any kind of, you know, numerical targets on that. They've really resisted doing that. And certainly on, like, you know, the progressive wing of the Democratic Party would love for them to define this a little bit more clearly, and they haven't done that. So I think that when folks are voicing a ton of concern about the fact that they're either on one side completely hemming themselves in and going to have zero wiggle room, or on the other side completely uncommitted to this and just, you know, talking a nice talk, but they're not going to walk it. I think both of those are probably a little bit, you know, far afield of what they're actually doing, although, you know, it clearly remains to be seen. Everything I'm saying is predicated on the fact that they just introduced this last August. There doesn't seem to be a ton of agreement on the committee about what these goals even mean. Like different average inflation targeting and inclusive employment outcomes mean different things to different people, including within the Fed itself. But I think the best summary that I've come up with, that I use in my stories and that seems to ring true to basically what the core of the committee is saying, is that the Fed is looking at a whole range of economic indicators that it didn't pay a lot of attention to before, partially because they realized how much they messed up in the last cycle. You know, they went ahead and hiked interest rates in 2015, which I think they now, several of them have said, and I think many of them believe, was earlier than they necessarily needed to. They probably hiked them a little bit more than was necessary in 2018. And so I think they're kind of doing a little bit of soul searching, thinking like, how could we not do that again? How could we not try and be preemptive and end up cooling off an economy that maybe doesn't need us to cool it off, for the very good practical reason that they don't want to continue undershooting on their inflation goal, which they have for decades now, basically. And so I think they're really reassessing how they think about the labor market. And when they talk about this broad-based and inclusive employment approach, I think what they really mean is these sort of indicators of how people at the margin were performing in the labor market actually gave us a much better view into how much room the labor market had to run in that last cycle. So for example, we had just counted out a lot of, you know, Black women, Black men, Hispanic women, women with children. We thought they were never coming back into the labor market. And it turns out that if you get wages high enough, if you get, you know, a strong enough labor market with enough job openings, you can get some of those people back. And so maybe paying attention to them offers a slightly better guide to where full employment is. And I think that that is what they mean when they say they're looking at these things. I think that, like, the interpretation that they're just going to, you know, set some sort of Black unemployment rate target for the job market is, I don't think is well supported by the things that the core of the committee is saying when they talk about these things.
Okay, that's great. We've got lots and lots of questions. There's several variants of a similar one that's come up, and I guess I'll start with that, and I'll ask each of you to comment on this, which is, how do we try to regain the public's trust, and how do we bring the public back on side to say, you know what, experts actually can add value. There is there are cases where there's a right and a wrong answer. You don't have to say on the one hand, on the other about everything. How do we, kind of undo where we are? What are the steps that we can do? And if you want to give it specific examples, go ahead, or just anything broad. So let's start with Jeanna. We'll go in the other direction. So.
I think one thing that is really important, and I think the last administration showed this, is sometimes there are clear yeses and nos, like there are just clear sides on the debate, and sort of acting like the sort of trying to achieve some sort of artificial balance between one political talking point and another can actually be pretty damaging, especially when we're talking about something that is provable. I do think, however, that it's important and incumbent upon the media to, when there is actual valid intellectual disagreement, to show that. And so I think one way that we can sort of re-inject trust in experts is to be clear about sort of the definitiveness of expertise. I think one thing and I'm mostly talking to my own experience and when it comes to monetary policy, I think one thing that we do that occasionally erodes trust in our reporting on experts when it comes to monetary policy is we just kind of state as like established rules, things that are really theories, like well-believed theories. And I think we just need to be extremely precise about what we mean. And when I say that, a good example that comes to mind is things like people will just say like inflation hurts the poor, and there's actually not a full consensus around that. And I think it's important to say like who we're citing, what we mean, what the expertise shows, what the expertise doesn't show, what we don't know, and just to be very, very clear about those things. And I think that can sort of help to do a lot of the work towards reestablishing trust in experts.
Catherine?
Sure. I was thinking about this expression that I heard a couple of years ago. I don't know if this is some cultural idiom from another country or what, but it was something like trust comes in on a turtle and rides out on horseback. I don't know if others have heard this idea, but it is really, really hard to build credibility and trust, and it is very easy to fritter it away. And I think we need to think in those terms with everything we as journalists write, with every comment that experts themselves or politicians or anyone who is seen as a voice of authority mentions, because once you sever that level of credibility, people don't believe anything you say after that. And again, this is not just about like academic experts. I mean, this was a large problem with, for example, the approach to informing the public about the pandemic last year, that at the point that you had an administration saying, whatever it was, 15 cases will go down to 0, to write off anything anybody else said, any messaging that came after that. So it's partly about building your credibility over time. I think it's partly about, as Jeanna reflected, trying to be transparent about what is known and what is unknown, and expressing some humility but clarity. These are very difficult things to get in balance. And I find this especially challenging for me because I write an opinion column where I'm supposed to be making an argument about something, right? And so when I'm thinking about what I'm going to write, I try to think about what do I think is true? What do I think is, interesting enough that people will read it, but is like, won't leave me embarrassed 6 months from now or whatever. And you have to sort of think about that long-term relationship that you have with your audience, and experts need to think about that as well. And I think just in general, thinking about how to communicate things to the public. One technique that I've heard of, I forget who coined it, but there was some like media scholar last year or the year before who talked about the concept of a truth sandwich, that when you're debunking a misperception about some issue, you need to be very careful about how you frame the debunking, because people may hear it but only remember the false part. Like if you say, it's not true that, I'm trying to think of a good example, it's not true that the sky is green. What people may remember from that interaction is, I heard something about the sky being green. And so thinking about how you communicate particularly when you're trying to correct a misperception, is very important for building credibility and for actually getting your message across. And the idea of the truth sandwich, that term was like, you start out with the thing that is true. The sky is blue. Then you say, we realize you may have heard from some other people that the sky is green. And then you have the other part of the bread of the sandwich, or however this metaphor goes, and say, but in fact, here's how we know the sky is blue. And you kind of show your work, but you also make sure that you package whatever message it is that you're trying to get across in such a way that people actually remember the thing you're trying to get them to remember, and that they trust that you did your homework, and that you know, that they come, basically that the thing that you want to stick with them sticks with them.
Yeah, that's helpful. Chris.
Thank you. I think the truth sandwich is a very, very nice way of putting it. I would say, I think this applies to the media, maybe more outside, certainly outside the US quality media, but it applies in other countries really highly, is that there's the importance in the journalists having some expertise themselves, and far too often they don't. And it's really hard to build trust when they might be just in a job for a short amount of time in quite a specialist area and really not know what they're talking about, and just wanting to make a splash and then get on with their career in their part of journalism or another part of journalism. And I think that's really problematic. So having news organizations that really care about get the truth is really important. It's hard, again, if you don't. In that, I think what Jeanna said about no artificial balance is really important. If there is a genuine, a true and a fair position, it's much better to try and explain that, how and why. Why do people think like this, and why is this right, rather than giving two sides and setting up an argument. I think we do need to be clear and honest about what we know and we don't know. And there's some issues where the public are just so set on a view. I think Catherine's point about the incidence of taxation and the progressivity of certain taxes, where economists will say it's the system that matters, it's the progressivity of the system, not the progressivity of one tax. You cannot get that across. I mean, I don't know how many times I've tried on that particular message and failed miserably. And so don't be a headbanger and keep banging, against, do the things that can work, and don't try and change the whole world.
Okay. We've got a bunch of questions that are targeted at each of you, so I'm going to pick one for each of you that have come in. Let's go to Chris. You said in choosing between fair and exactly truthful, you'll pick fair every time. What's your definition of fair, and how do you balance that, or how do you define fair, and how do you know that you're hitting that?
That's a good question. I think it's being precise and wrong is worse than being roughly right. So I try and define fair as being roughly right. And again, it comes back, I think, to making sure that you yourself know the arguments, understand them, and are as honest about what you know and what you don't know. And this was particularly the case during the pandemic, where economics and the epidemiology intertwined in an important way. And knowing what you know and what you didn't know and what you can say meant that you could never be precise about something. It was much better not to try and be precise, but to try and be as fair as possible and be roughly right, to say that as far as we know, so to take the pandemic as and what was the link between economics and the pandemic in real time, as far as we know, and I think we still think this, it is the direction of causality goes from the disease to the economic performance. So controlling the disease means your economic performance will be better. Not in every country, not at all times, but that is a generality. And so there isn't a huge trade-off between opening up an economy from lockdown and the economy. So between the disease and the economy. So you can create a false trade-off there that doesn't exist. And I think getting some of these things across, how do we do this, try and do this in fair ways? Well, we try to do this by looking as far as you could in real time, with scatter plots about performance and the disease. And you know that a lot of the data was rubbish and it wasn't correctly measured and all of that. And so you knew it wasn't accurate, but you knew it was roughly fair. And it was also reflecting the top opinion as it was developing. Had that changed, again, you would have had to change and be honest about whether you change your mind, because the world changes.
Okay, that's great. Catherine, one of the questions that came in where you were talking about trying to, be accurate and say exactly what we can. One person pointed out that some of the problem is that you have these very, very low information voters, and that they're not reading any of your publications. They're and that the true sandwich kind of helps, but they don't even, they're snacking on donuts or something. I mean, they're not really searching for the truth. Are there strategies that we can have to try to raise basic literacy about economics for the people that don't find it interesting and don't really want to do anything, don't want to make the investment that is needed?
It's a really hard question. As Chris points out, there is a large contingent of your audience as a journalist who is really not invested in figuring out what the right answer is necessarily, or at least maybe that's making too strong of a case. That they have an idea of what the answer is, and they're not really going to read your stuff that closely, particularly if it doesn't conform to their priors. They know Brexit is bad, or they know Brexit is good, or whatever, and evidence doesn't really come into play. And I do feel like I have readers who willfully misread stuff that I write. But I can't control that. All I can control is how clearly I present the information. I had an English teacher in 6th grade who drilled into my head the idea that if a reader misunderstands you, it is your fault, not theirs. And I try to abide by that dictum as a writer, to be as clear as possible, to try to not be misunderstood. Like I said, a lot of what I do, I feel like, is a little bit of defensive writing, meaning that anticipating how someone is going to misunderstand something that I write, and try to prevent that from happening, in addition to making the affirmative case for whatever it is I'm saying. And this is true not just in economics. I write about immigration frequently, for example, and I almost always have some sort of boilerplate. If I'm writing about the legal immigration system, getting a visa, things like that, I almost always have some language in there that says, once again, we are talking about the legal immigration system, not people who are undocumented. And I write that, and my editor always tries to take it out, and I say, no, you don't understand. If I do not spell that out, people always write me a response saying, why do you want all of these illegals or some other epithet to come here? And I'm like, nope, these are people trying to come here legally. And so I just have to bend over backwards to try to make things as clearly understood as possible. Now, to your point, they may not be reading me. I can't control them. They may be, no matter how clearly or persuasively I try to write something, they may, write me off and say, I don't trust her. She's not trying to reach people like me. I'm going to get my information from Newsmax or someplace that does, that conforms to their priors. And that's very challenging. I guess the remedy is a better US education system so that people have greater media literacy. I would love to see that. I would love to see some part of the school curriculum address how to interpret different kinds of media. Although it's so that people have a better understanding of what is opinion and what is fact, and how to weigh evidence and things like that. Although, interestingly, I think there's been some survey research to suggest that the age groups that are best at doing that are already younger people. The demographics that have the greatest difficulty kind of knowing how to interpret different kinds of media tend to be older readers who could be for lots of different reasons, but it could be because they're not used to, consuming so much potentially disinformation. So, you're not really going to be able to fix people who are no longer in school so that they can have a better understanding. But it's a really challenging problem. The best I can do is try to be as clear and transparent as possible, you know, including that I'm an opinion columnist. I try to adhere to the facts, obviously, as all journalists should. But I am making an argument for something and try to point out to people what the counter argument might be and why I disagree or whatever. But it's about transparency and clarity.
Okay. So Jeanna, the question I was wondering about for you, you mentioned that this determined Fed conspiracy contingent out there. How much of a problem do you think it is that social media has so few constraints on what can pass as kind of fact and spread like wildfire? We've seen these studies that find that false stuff spreads faster than true stuff and so on. Do you think that the presence of social media in its current form is kind of undermining expertise and perhaps needs some sort of constraints? I mean, it's a pretty slippery slope to start constraining people on what they can say, but I'm curious what you thought about that.
You know, I think it's interesting because I think it can kind of hit both ways. You know, on one hand, if you've got a really pithy, compelling false narrative, it just spreads around the world in 30 seconds. You know, they do go fast. On the other hand, it also, like, these institutions are on social media. All of the people who do have some sort of, you know, basic level of journalistic expertise are on social media. And so I think that you can really kind of, if you see something spreading, there's an ability to kind of like hit back in a way on social media that maybe we wouldn't even have known that conspiracy theory was spreading if it weren't for the fact that it's all over Instagram or Twitter or whatever social media channel we're on. I think, though, that one big challenge is the stuff that kind of exists in the gray space. So like there are often things that will spread on social media that are just like almost impossible to debunk in real time, even though you think they're probably completely, you know, false. And I think that those are really challenging. And this is a bit afield from the Fed, but like, for example, at the start of the recession, women just dropped out of the labor market like crazy. This is like now a well-known fact, but at the time it was kind of novel and we were writing about it. I was writing a lot about it, and you would tweet something to that effect out, and, you know, just a million people would pick, well, not really a million, but thousands and thousands and thousands of people would retweet my tweets, but with things like, oh, some women are realizing they just like to work at home now, or they want to take care of their families. They're like rediscovering their place in the household, because these sort of far right, they tended to be far right groups were kind of jumping on this stuff and running with it. And it's like, there's some portion of the internet that wants to be misinformed about these facts, refuses to not be unmisinformed. And it's really hard for me to say like why women are dropping out of the labor market in real time. The best I can do is the microdata, and the microdata show that it is to take care of kids. You can't say anything about like whether that's choice versus preference, or choice or preference versus need. I would, you know, make the compelling case, and I think now we can make the compelling case that it was need. But it's really hard to control stuff like that. So I think there are certainly instances where in the moment it can really, you know, spread bad misinformation. And then there are also times when you can use it as a tool to combat that bad information.
Okay, thank you. We've got time for each of you to speak for about another minute. So I'm going to offer you a two-part question. You can either, if there's something you'd like to get in that we haven't talked about or just respond to, you can use it that way. Or one of the listeners asked, can you give an example where you changed your mind about something? You've just concluded that, you know, you've written something and now you're on the other side. And then how did you go about, you know, getting that across to your reader? So if you want to answer that, that'd be good. I think that's a tough question. But if you want to just offer any final thoughts, that's okay too. So let's start with Chris, and we'll Catherine, and then Jeanna.
Yeah, there's certainly okay. I mean, I'll go back to Brexit. I certainly thought my prior was the initial impact of the vote would be more serious on the UK economy than it turned out to be. And I both report and I write opinion columns, and I've certainly written opinion columns saying it was going to be worse than it turned out to be. So that would be the summer of 2016. And I think in January 2017, when it was absolutely clear that I was wrong about that, I did an opinion piece saying I was wrong about that. What have we learned? What have I learned? And I think I did it pretty openly. And I think that was quite important for trust, because I was getting a lot of people saying, well, aren't you totally wrong about this? And the answer was, yes, I was. And it was a piece of forecasting. I got carried away partly in the referendum, as lots of people did, and got carried away about the short term rather than the long term, where the evidence was much weaker in the short term. And I think you just have to hold your hands up, and you do it publicly. That's what you do.
I see. Okay, very good. Catherine?
I'm thinking about things that I've written about in the last year. I mean, early on in the pandemic, I'm trying to remember if I actually wrote this explicitly, but I was in favor of closing schools. I vaguely remember that there was some research that had been done about the Spanish flu, you know, over 100 years ago, that showed that cities that had closed down earlier, including their school systems, had stronger economic recoveries, and that made sense. You know, I was making the argument that in the long run, what would be good for public health, what would be good for the economy would be the public health threat, which included limiting transmission in schools. And since then, obviously, we've gotten a lot of data suggesting that schools are not a major source of transition. And I don't know that I've explicitly said like my views have changed, but I have written a bunch of things about how there has been major learning losses, and that will have huge consequences for kids today, in their immediate academic and developmental and social milestones, but also in the long run on their economic potential. So I don't know that I've like explicitly communicated to the public, like I once thought this and now I think this other thing, but I'm certainly writing. Maybe as Chris points out, I should like make more clear that my views have changed on this. But I think we also have more evidence on the question. But that's one thing where, you know, data comes in and you should take into account the data. And I'm very concerned about people kind of the inertia that has continued since last year in terms of fear of spreading the virus through schools, and very worried about kind of a lost COVID generation. So that's one thing that I thought about.
Okay, great. So Jeanna, you get the last word.
I think, you know, I'm not an opinion columnist. I write news, so I don't generally take views, but I do think one thing that I've reflected on a lot is during the last business cycle, I think I was especially guilty of sort of reporting when economists and businesses said that the labor market was tight without really being dogmatic about asking them what that meant. Like what is a tight labor market? Are you talking about some sort of non-accelerating inflation rate of unemployment? Are you talking about it's harder to hire this year than it was last year? Like what do we mean when we say tight? And I think that was something that the media broadly did that had real consequences for policy. Like it's not like policymaking exists in, you know, its own little snow globe. The policymakers are reading the news we write. And I think if we had been a little bit careful or more careful to ask what tightness meant, maybe it would have been informative for policymakers. And so I think that's something that I really took a lesson away from. And you know, I think part of that arose from this desire to be simple in explaining things to our readers. You know, it's a lot easier to not explain Nehru in his story. And I think that that's where it came from. But I think the big lesson that I took away from it, and I think an important lesson about sort of expertise in economics and journalism, is that readers are often smarter, I think, than we give them credit for. Like normal people are smart. People can understand these concepts. And very much like Catherine said, it's incumbent upon us to make sure that we're writing in a way that, you know, can be understood. If you're misunderstood, it's your fault. There's a way to say these things simply. And I think sometimes you just have to go the extra mile and like put in the work to make sure experts can be understood. And yeah, I think that was my takeaway from that whole business cycle.
All right. Well, look, thank you to each of you. A remarkably frank discussion. You guys do a great public service by writing so clearly about economics, and I hope you'll keep doing it. And I hope you've enjoyed this as much as I did. That's going to wrap up our session. There's another round of breakout sessions for the management conference starting in 10 minutes. So I encourage you to go